Have you ever felt like you're watching a story unfold where you know the ending, but the rest of the world hasn't caught on yet? For 50 years, the price of silver has been dictated by a financial story, a kind of fairy tale told on trading floors in New York and London. But right now, that story is smashing head-on into a physical reality that can no longer be pushed aside or ignored. Welcome to the Bullion Signal Podcast, the channel where we cut through the noise to analyze the macro trends and precious metals that define the safety of your wealth. Today, we're diving deep into the silver market because what we're seeing isn't just a trend, it's a squeeze, and it is officially on. If you're looking for a clear signal in a world full of economic noise, make sure you subscribe to the channel. Let's get into it.
To really get what's happening, you have to understand that silver has been living a double life. For most of modern history, we've had the old story. In this version, silver is a monetary metal, but it's always been treated like gold's less important little brother. Its value was defined by its relationship to gold, something to be traded, often on paper, but never really seen as a critical asset in its own right. But now, a powerful new story is taking over. In this new narrative, silver isn't just money, it's the technology metal. It's the single most essential, most irreplaceable metal for building our future. And here's the critical point. These aren't two separate stories anymore. They are two freight trains on the same track, and we are hearing the sound of them colliding right now.
So let's look at that old story for a minute, what some analysts are now calling the paper lie. You see, for decades, the price you saw for an ounce of silver had very little to do with how much physical silver was actually being bought or sold. It was determined in the paper markets, primarily through futures contracts. Now let me put this simply. It was like a giant global poker game where for every single real silver coin on the table, the players were betting with 100 paper IOUs. This system allowed a few very large financial players to control the price using enormous volumes of paper promises, effectively suppressing the true value of the physical metal itself.
But that paper phantom is starting to vanish because the new story isn't a story at all. It's physical reality. And you can't argue with physics. This is no longer about trading algorithms or derivative contracts. This is about real, tangible silver being consumed by real, world-changing industries at a pace that is simply breathtaking. The demand is real, the consumption is permanent, and the market is waking up to a very simple and very stark truth. There just isn't enough to go around anymore. The physical world is finally taking back control from the paper one.
Okay, so let's get into the heart of this physical reality. I want you to picture the world's registered silver stockpiles, the big vaults in places like London and New York, as one giant bathtub. For decades, the tap, which represents all the silver coming from mines, was able to keep the tub comfortably full. But this explosion in industrial demand has pulled the plug out of the bottom of the tub, and now the water level is dropping. Fast. This isn't a slow leak, it's a great physical drain.
And here's where it gets really serious. This isn't a recent development. Look at this number, 5. For 5 consecutive years, the world has physically consumed more silver than every single mine on Earth combined was able to produce. Think about that. For half a decade, we've been running a physical overdraft on our global silver account. And just like with any bank account, when you spend more than you earn, you have to start draining your savings. That is precisely what's been happening to the world's silver.
Let me be absolutely clear here. This is not a statistical blip. This isn't some one-off accounting error or a temporary supply chain hiccup. This is a deep, structural imbalance in the market. And what's more, it's not getting better, it's getting worse. The gap between what we need and what we can mine is getting wider with each passing year. This is a trend that is now locked in and accelerating. So, what's the consequence of this 5-year deficit? Well, here it is. To fill that ever-widening gap, the market has had to pull a staggering 820 million ounces of physical silver out of those global inventories. I want you to really grasp the scale of that number. We're talking about a volume of metal that weighs more than 2 Eiffel Towers. And here's the most important part. That silver is gone, for good. It's not sitting in another vault somewhere. It has been consumed by industry. It's in your solar panels, your phone, your car. It is never coming back.
So, this begs the question, where on earth is all this silver going? Why this sudden, insatiable appetite? The answer is simple. It's not being hoarded as money. It's being woven into the very fabric of our 21st century technological world. One market analyst cleverly borrows a term from science fiction to describe silver's new role, unobtanium. Now, it's not because silver is impossible to find. It's because for its most critical modern applications, there are simply no viable substitutes. You want to build a satellite? You need silver. Advanced medical devices? You need silver. High-end electronics? You need silver. It has the highest electrical and thermal conductivity of any metal on the planet. You literally cannot build the future without it. And this incredible, non-negotiable demand is really standing on three massive pillars. First, you have solar power. And get this, the newest, most efficient solar panels actually require more silver, not less. That demand alone could double by 2030. Second, electric vehicles. An EV uses nearly twice as much silver as a traditional internal combustion engine car. And third, the one nobody was talking about 2 years ago, AI infrastructure. The high-speed servers and data centers powering the AI revolution are completely dependent on silver's unmatched conductivity. These are not fads. These are global megatrends. And so this brings us to the central question, the economic problem that the market is now being forced to solve. What happens when you have exponential, must-have, non-negotiable demand from the world's most important industries, and it smashes head-on into a supply chain that is fundamentally incapable of responding? You get the perfect recipe for a price explosion. Okay, so we've established the demand side is on fire. The logical next question is, well, why don't we just mine more silver? Why can't the mining companies just flip a switch and increase production? The answer is actually one of the most misunderstood parts of this whole story, and it reveals a massive structural problem on the supply side. In economics, the supply of silver is what's known as inelastic. All that means is that even if the price goes way up, the quantity produced doesn't really increase much, or at least not quickly. Think of it like trying to get more avocados in the winter. The price can double, but farmers can't instantly grow more trees. For silver, that growing process means building a brand new mine, a project that easily takes 10 years and costs billions of dollars. You can't just turn on a tap. And here is the absolute key to understanding why supply is so inelastic. Look at this chart. Over 70% of all the silver mined in the world today doesn't come from actual silver mines. It comes as a byproduct. That means mining companies are digging for copper or lead or zinc, and they just happen to find a little bit of silver along with it. So put yourself in the shoes of a mining CEO. Let's say the price of silver doubles or even triples. Are you going to spend $10 billion and the next 10 years of your life to build a new copper mine just to get a tiny bit of extra silver as a side product? Absolutely not. Your entire decision is based on the price and economics of copper, the main metal. The silver price is barely a rounding error in your calculation, and that is why the supply cannot respond. So you have this perfect storm brewing. Unstoppable, exponential demand on one side, a fixed, unresponsive supply on the other, and an inventory that has been drained to the bone. This is the dynamic that is creating what analysts are now calling the inevitable squeeze. It's like a boa constrictor slowly tightening its grip on the market. And every year that physical deficit continues, that grip gets tighter, leaving the old paper market with less and less room to breathe. One of the clearest warning signs that this squeeze is intensifying is the gold to silver ratio. This is simply a measure of how many ounces of silver it takes to buy 1 ounce of gold. Historically, it's hovered around 85 to 1, but recently it's collapsed. The last times we saw this ratio break down so dramatically were just before silver's massive historic price runs in 1980 and 2011. History is showing us that when this relationship breaks, silver doesn't just go up, it can reprice violently higher very, very quickly.
This breakdown of historical patterns is causing visible stress in the market. For instance, we still see these sudden aggressive sell-offs, what traders call price slams. For years, people saw these as proof that the big banks and paper traders were still in complete control. But the interpretation is changing. Now, more and more people are seeing these moves for what they are, acts of desperation. It's the final frantic attempt to keep a lid on something that is about to boil over.
One source puts it about as bluntly as possible. They are selling a promise that they can no longer keep. The they here refers to the large institutional players who have massive short positions. In other words, huge bets that the price of silver will go down. They make these bets by selling paper contracts, which are, at their core, a promise to deliver physical silver at a future date. But with the vaults being drained dry, that's a promise that is becoming physically impossible to fulfill.
And so this leads to the projected endgame, a three-step process. Step 1, panic. One of these attempts to slam the price down fails and the price snaps back up. This triggers a panic among all those who are short. Step 2 is cascade. These trapped short sellers are forced to buy back their positions at any price, just to stop the bleeding. This forced buying creates a cascade of upward price pressure. And finally, step 3, reset. The price doesn't just edge higher, it launches. It breaks free from the paper market and resets at a completely new level, one that is finally dictated by the hard reality of physical supply and demand.
So, let's just quickly recap what this all means for you. What are the key takeaways you need to have on your radar? First, the entire silver narrative has changed. Unstoppable industrial demand is now the primary driver, not monetary speculation. Second, the paper market, which has suppressed the price for 50 years, is visibly losing control. Third, the physical inventory buffer that they relied on to maintain that control is now gone. And fourth, the supply side is structurally broken and simply cannot respond quickly to higher prices. The entire game has changed. Which leaves us with one final, very provocative thought. What happens when the foundational story of any major global market is finally and completely proven false by physical reality? We're seeing it in silver, but it's a question that has implications far beyond just one metal. It's a warning shot across the bow for any market that has been built on a foundation of paper promises instead of tangible value. It's a situation worth watching very closely. Thank you for tuning in to the Bullion Signal Podcast. If you found this analysis valuable, please hit that like button, share it with someone who needs to hear this, and be sure to subscribe so you don't miss our next deep dive. And just as a final reminder, this content is for informational and educational purposes only. It is not financial or investment advice. Always do your own research and take responsibility for your own financial decisions. We'll see you in the next one.